Hello and welcome, ladies and gentlemen, to another episode of The Cautious Trader. Today, I bring you another beautiful article represented by Financial Flagship. Thanks a lot again to this account on TradingView. And today's episode is dedicated to the Fibonacci sequences. A lot of the times you see in my charts, I do draw up the Fibonacci series or the Fibonacci sequence, and I utilize the levels that it provides as to where we might see Bitcoin coming down to or going up to in a downtrend or an uptrend. So that's why I wanted to dedicate today's video into describing the Fibonacci sequence, what it is, and how it works. Okay, so without further ado, let's jump into this article courtesy of Financial Flagship. So it says, in his historic 13th century novel, Libre Abaci, Book of the Abacus, Leonardo Fibonacci brought a special sequence of numbers known as the Fibonacci series to the Western civilization. So what are these and why are they important in the technical analysis realm? Well, it's because these numbers and these series have some unique characteristics, and a lot of the times you might have heard of the Fibonacci sequence if you have seen YouTube videos about trading, or you might have actually seen people talk about the golden ratio. So where does the golden ratio come from? Well, let's have a look. What is the Fibonacci series? It's a simple mathematical expression that describes a series as follows. So f of n plus 1 equals f of n plus f of n minus 1. What does this mean? It means that basically any number in the series is an addition of its previous number plus the number previous to that. So if we start from 5, basically 5 is 2 plus 3. If we start from 8, 8 is 5 plus 3. And we go on and on and on until infinity, essentially. So the ratio of the current Fibonacci number to its immediate previous number, that is the ratio of f of n plus 1 over f of n, or f of n over f of n minus 1, is a special and somewhat mysterious characteristic of the Fibonacci sequence. Why is that? Well, it's because in nature, a lot of the times we see this sort of ratio or approximation of these ratios come up. And they come up quite naturally, not as a product of man-made objects or man-made design, but rather in a sort of natural God-made design, if you will. And also because they come up in nature, a lot of the man-made designs and architectures try to imitate these sequences and also these ratios. And that's why the golden ratio in photography is so important. If you guys are into photography, that's why, for instance, the golden ratio in faces is so important. That's what describes a beautiful face, for instance. A lot of the times people describe it as such. And flowers, for instance, follow that. And architecture follows it also. So what is this ratio that we're talking about? Well, let's have a look. It says when we move further out into the Fibonacci sequence, this ratio reaches 1.618 to 3 decimal places. In truth, it turns out that it doesn't matter which two numbers were chosen to start the series in the first place. It will still hit 1.618 to 3 decimal places as we proceed along the list. The unique ratio is referred to as the golden ratio, or phi. So we already know that phi is 1.618, but here's some other ratios. 1 over phi is 0.382. That's an important Fibonacci level I always refer to. perhaps one of the most important ones. We have phi squared, which is 2.618. 2 over phi, 2 over phi minus 1, 0.236, square root of 1 over phi, 0.786, square root of phi, 1.27. Says the items in this list of phi related ratios are related as significant ratios in technical analysis and are used widely by technical traders and analysts. And this is where I like to put my own commentary into it. As I mentioned before, a lot of man-made structures and architectures and designs try to imitate the golden ratio. So it is no surprise that markets which are man-made also would have the tendency to follow this ratio or these ratios, right? And this becomes sort of a self-fulfilling prophecy, because since everyone knows about these levels, then they will act accordingly, and we see structures be created on the markets and on the charts that follow these ratios. So long as there is not market manipulation happening and people follow these rules of Fibonacci, then it becomes a self-fulfilling prophecy. It says, Fibonacci numbers and ratios are often used to time future markets or time forecasts, as we can see in the following pages. Excuse me. Before going any further, it's a good idea to define these terms, which is retracement, extension, and projection in broad terms. So what's a price retracement? A market drop or reversal from a significant high or a rebound from a significant trough is referred to as a retracement. The amount of retracement is normally expressed as a percentage of the observed price range and is calculated by comparing the peak to a previous significant trough or a trough to a previous significant peak. In other words, we have both downside and upside retracement. Popular Fibonacci percentages include 2, 3.6, 38.2, 61.8, 78.6. And these are familiar. Why? Because we've seen them here. So price extensions are, what are they? They're as follows. A downside extension is any downside retracement that is greater than 100%. That is, the downside retracement extends below the previous significant trough that is beyond the observed price range. In a similar fashion, an upside extension is any upside retracement that is greater than 100%. That is, the upside retracement extends above the previous peak and that is beyond the observed price. And by the way, we'll go over some charts and I'll show you what these mean. And these price extensions are also as follows. And we have price projections. Any upside price projection is a projection of an observed price range from a higher significant trough. A 100% projection is simply a 1-to-1 projection of the observed price range from some new higher significant trough. Similarly, Fibonacci downside price projection use phi related percentages for forecasting potential support in a downtrend. The main Fibonacci percentages are these. And it says if you trade with care, then you'll be able to notice these. And yeah, if you like the content, make sure you follow these guys. They're definitely putting out some great content and articles on TradingView. And I will link this article specifically in the description. So let's look at a chart of Bitcoin, because everyone says Bitcoin doesn't follow it. Let's see if Bitcoin follows it. In my last episode, I went through how we have mini trends within larger trends. Sometimes we have these triangular formations happening In a downtrend, this would be called a bear flag because it looks like a flag and we're going down, hence the name bear flag. And usually we would break down and out of a bear flag within 60 to 70% completion of the flag itself. So if you look at here, we have, for instance, 27 days. That is the length of this bear flag. And we broke down and out of it by the 20th day. So the 2/3 level around the 60-70% range, and it broke out of it, right? Now, if you want to know what happens when we break a significant level, then we can just look at Fibonacci retracements. Let's say you were noticing this yesterday just as the price was breaking this bear flag, breaking out of it, and down below it you would say, okay, for instance, we're here, what's going to happen? Well, we could draw a Fibonacci retracement, and noticing that our price is dropping, we would say, okay, we'll probably hit this area of support at $31,310 and then bounce up. Then if it bounces up, where would it go to? This is where the Fibonacci becomes handy, because we can see exactly when it hit this level right here in the bottom, it comes back all the way to 0.382 level, retraces back to 0.236 level, beautifully retraces, and then goes back up to the 0.5 level. And I do have a feeling, again, not financial advice, entertainment and educational purposes only, I have a feeling that it might actually go to the 0.618 level and try out this 34,500 level of resistance. And this is how you use the Fibonacci's. You sort of look at it, where it's going, and determine from the last peak to the trough that you're in a downtrend, or the opposite. If you're going in an uptrend, you can also see it. Let's look at this chart in a different light. Say, for instance, we were going up this trend. We were at the top over here at this peak, and all of a sudden we start dropping, and we want to know, where is the support? Where is our support going to be? Well, we see that from this trough to this peak, our support lies somewhere around the 0.382 level to 0.5 level. And this beautifully actually coincides with this 45,000 level that I had drawn all the way back from here, right? So this is the way you utilize the Fibonacci sequence. And with that said, I know this was a bit of a shorter video. I hope you enjoyed it. If you have any questions or comments, leave them in the comment section below. And if you have gained something of value from this episode, make sure you like, share, as well as subscribe to the channel, because I will keep bringing you high quality content, high quality educational content every week, if not every week, every couple of weeks. So stay tuned for our next videos. Thank you very much for watching, and I'll catch you in the next one. Bye for now.